Welcome back. Keith Tibbles joins us now. You know, when you look to somebody for advice, there's also a leader of those advice givers. You know, Keith Tibbles has proven himself to really be a leader in the mortgage world, not only here in Seattle, but across the country, where he has grown the 26th largest private mortgage banker in the country. Well, first of all, welcome, Keith. How are you?
Good, Ben. Thanks.
Good. Did you brought the 4-wheel drive car, I hope, so you can get home and everything?
No, I probably should have, though, at this point.
Yeah. We spoke a little bit earlier on big picture mortgage. You know, Ryan and I actually spoke earlier on the show about, you know, people making decisions to buy a house, to refinance, and what those rates do. But in a bigger picture, you've been pretty involved in what consumers can expect, you know, over the next 12 months to 24 months. Talk a little bit about some of those bigger changes and as an industry-wide, mortgage industry-wide, what people will be looking at.
Well, I think the 2012 is going to be a year that we see some really positive things for households. The government has been trying for the last couple of years to try to find a way to get more and more people into refinancing their homes, but because of all of the negative equity in housing across the country, it's been a real challenge for them. A year ago, they rolled out a program called Harp 1.0, and it didn't really have the impact that policymakers and lawmakers really wanted to see, because there was a lot of change, a lot of things in it that made lenders nervous. Because for us, when we lend and refinance on a home that is negative equity, when that loan comes back to us, if it does, from Fannie and Freddie, which is most of the loans,
yeah, I mean that's where most people's loans are.
That's a really expensive experience, and so now 2012, the industry is rolling out at pretty much the urgency of policymakers and lawmakers, Harp 2.0. And they've eliminated a lot of the lender concerns about reps and warrants and things that can come back to us from the standpoint of financial risk. And so we expect that this program is going to be significantly more successful in providing homeowners with better interest rates and the ability to refinance their homes. Because as you know, a lot of people in America still have rates that are not really in alignment with the economics of our country. Normally, when the economics of our country begin to deteriorate, one of the benefits of coming into a slower economy generally is people can improve the household disposable income by refinancing their home, but many people have been locked out of that. So while in 2011 and 2010, Harp 1.0, you know, I think the industry estimates were that it would do around 25. It did around 25 billion. Estimates this time are that Harp 2.0 might be somewhere around 200 billion in refinance loans in America, and that's a real positive thing for consumers.
And, you know, we talked and being positive for consumers, it's also positive, and Grant was talking about this earlier, for even smaller banks, because they take a lot of the risk off of you, right? I mean, I think that's kind of what you mean is, you know, you get into these lower interest rates with houses that are underwater. You know, it's tough to say if people are going to keep that house in a year or 2 years. But in this case, it seems like, I mean, tell me if I'm wrong, the government is actually taking the risk. Just what they need is more.
Well, keep in mind these are already loans that are owned by Fannie and Freddie. So when those two companies went into conservatorship in 2008, that risk pretty much flowed to the government. So there's not really an increase in risk for the government's position in those companies. It actually probably improves their risk because, as you can imagine, when house payments go down, people can afford their payment more, and so it probably improves the overall credit risk. The underlying asset risk hasn't really changed in terms of the position that the government's been in since 2008.
So really, you're really just giving. They're trying to give people lower payments so they'll keep their houses.
Yeah, because you know that group of homeowners is the current group that we're seeing strategic defaults occur in, and a lot of times that's just out of sheer frustration with sort of being disenfranchised with the process, right? Because you might be holding on to your home, and you may have seen people walk away from their homes in your neighborhood. And if they walked away from their homes 4 years ago, today they can re-enter into the market. right?
At a pretty steep discount.
Right. And so now they could re-enter into the market. They can get a mortgage, and they're buying down in value the same house that they walked away from. And if you're the person who's been trying to do what you consider to be the right thing, it's a very frustrating thing. So we think that this will have a positive impact on those people who've been sort of disenfranchised by policy and by process over the last several years.
Well, and people have their different, I call it social and ethical reasons versus their financial reasons. Looking back, if you walked away from your house 4 years ago, probably a decent decision. If you did 100% loan. But in this case, and you had talked about this with me earlier, you have this faster amortization, which you think will be, if people choose a loan that will pay down their loan faster, like a 15-year, like a 10-year or 20-year, you think there's going to be a bigger discrepancy than maintaining that 30-year, plus their payment might remain the same.
Yeah, there's two motivations probably for people who are looking to refinance their home under Harp 2.0. One is the homeowner who really wants to have some sort of payment relief, and it might be because they may be a dual income family, and one of the income earners lost their job, and they really do need some household payment relief. The second is somebody who looks at it as an opportunity to try and work their way back into positive equity. And they've constructed within the Harp 2.0 program incentives for people to choose a 20-year amortization loan or a 15-year amortization loan. Because keep in mind, most of these are going to be high loan-to-value, people who are significantly
potentially underwater. Otherwise, they could have maybe done this a year ago.
They're all going to be underwater. And so the incentives that they built into the program are designed to help them amortize their loans faster. And so people who choose a 20 and a 15-year amortization will have better interest rates than a typical 15 or 20-year would have compared to a 30.
Is that going to go through to the purchase side too? I mean, with rates being so low, we talked earlier about this potentially being one of the best times to buy. We actually had somebody in here earlier talking about there was a house with 16 offers on it in Wallingford over the weekend. Well, with mortgage rates low, on the purchase side, right? I mean, is there the rates will remain low, of course, but this doesn't really affect new purchases as much. I mean, people are going out, they're getting their own loan, but you had mentioned that maybe the cost of money or the rates will go up just a little bit as some of these programs are implemented.
Yeah, the Harp 2.0 program is really targeted at keeping people in their homes and for the homeowner who wants to refinance. On the purchase side, you have another policy objective, and that is the objective to try to reduce government's exposure to mortgage lending. And the way that they do that is they've chosen a policy mechanism called crowding in capital, because the government has a tendency to crowd out capital when they enter into markets. Crowding in capital is when you take a Fannie Mae and a Freddie Mac or an FHA loan and you make it more expensive over time. So no matter what the interest rate market is, if you effectively increase, let's just say the government profit margin on that, not that the government makes profits in that lending activity, but as they increase the cost of financing in general, it increases the profitability for others to enter into that market. And so this crowding in process is a process that, from a policy standpoint, is on the other side of this other objective of trying to help people save money on refinancing. And it's going to, this year, have a tendency to make mortgages more expensive as a result.
And so, I mean, you truly do see rates going up towards the end of this year on purchases, which could mean, I mean, again, I said earlier today, I think people are going to look back in 2 years and go, I should have bought in 2012 the same way they say they should have sold in 2008.
Yes. Even if the interest rate market stays where it's at, which, hopefully we're seeing signs of some sort of economic stability. And as that continues, it'll have a tendency to move rates up. Although the Fed is from a policy standpoint saying and still signaling that they're anchoring the short end of interest rate market till 2014. But so even if the interest rate market stays the same, this year alone, beginning on March 1st, we saw out of Washington a policy-driven increase on interest rates for Fannie Mae and Freddie Mac of 10 basis points to consumer. That was to pay for the tax extension at the end or the beginning of the end of 2011, beginning of 2012. Unfortunately, that that 10 basis points will be charged on every loan that Fannie Mae and Freddie Mac does till 2021. And people who make the payments on those mortgages will be making payments on those mortgages probably for a very long time.
Well, as you said, it's kind of, there's a lot of money in the mortgage industry, in real estate, and the government doesn't have a lot of money. And you said it's kind of low-hanging fruit.
So they're trying to balance sort of. I would argue that was not a good policy decision that they made, because they're taking home ownership and they're trying to pay for an employment tax break. But down the policy line, for sure, we're going to see other increases just like that increase. And in fact, the regulator for Fannie Mae and Freddie Mac, which is FHFA, has said that 2012 they're going to be imposing another increase in rates in the same manner that they imposed on March 1st. So that crowding in process is going to generally take interest rates higher.
Well, Keith, I have a feeling one day you're going to be helping write some of that policy in another life.
God help us.
Again, that's Keith Tibbles, president of Cobalt Mortgage, the 26th largest private mortgage lender in the country.